Ladies and gentlemen, welcome to the Motivate Property Podcast. My name's Corey Jones, the founder of Motivate Property Group. Thanks everyone for listening. So guys, this week's episode, what we're talking about and actually responding to is a question from one of our recent shows from one of our amazing clients, James Johan. So firstly, shout out to James. Thanks for sending through this question, man. So basically this week, James's question came off the back of our negative gearing podcast we did a couple of weeks ago. Now, just to, I guess, kind of start with, I did sort of make a bit of a passing comment, and to be completely honest, it was a little bit hyperbolic. What I was really talking about is the fact that, there is a lot of people out there when it comes to buying a property, they choose to negatively gear it purely because of tax, right? And really what I was trying to get to was the fact that, firstly, that's a terrible strategy. And one of the comments that I'd made was the fact that I can think of 10 other strategies right now that's way more appropriate to reduce tax than just taking on the risk of buying an investment property and negatively gearing it for tax purposes. In other words, what I was really trying to say is don't buy property for tax reasons. There's a number of levers you can pull before you go down that road. But again, what I'm trying to speak to is the fact that I see so many people out there, particularly business owners, get advice from their accountant. Their accountant said, "Oh, you're paying so much tax. You should go and negatively gear a property so we can help reduce your tax." That is a bad move. And that's fundamentally really, I guess, kind of the overall message of what I'm trying to say. Now, James's comment, and I respect this. This is a freaking fantastic question. He basically said, "Hey, what are those 10 ideas? Can you explain those 10 ideas?" So what I want to do today is actually explain those 10 ideas, right? Like I said, it was slightly hyperbolic. In fact, I've got 9 different ideas on my screen here that I want to run through you guys. But again, these are just purely ideas that should open up the door to start creating some other opportunity to help you consider and ask these questions to your accountant to potentially, hopefully reduce tax, rather than just buying an investment property purely for tax purposes, right? And that's, I guess, kind of today's show. Now, like I said, just to start with, really, this is fundamentally dealing with people's attitude or context at buying property. Now, just to make this really, really clear at the beginning, we do not buy property for tax reasons. Bad move, bad idea. That's really what I'm trying to sort of explain in that last show. Tax is a byproduct. It's a bonus. It's a benefit. We buy the property for growth. We want that growth to then provide us cash flow in the future and reinvest into other cash flow assets. Fundamentally, we buy investment properties for wealth, not just to minimize tax. Again, this is speaking to the guys who are using it purely for tax reasons, right? And all I'm really saying here is it's a bad move because there's other things you can do to reduce tax if you really want to reduce tax. The other thing to consider, not everyone wants to be a property investor. Not everyone wants to take the risk of dealing with tenants and holding properties long term. And so again, if there are let's just say 10 other strategies that you can deploy rather than taking on the risk and dealing with owning an investment property, well, it makes sense to me. If you want to minimize tax, try those first before you try property. But again, what I'm really trying to encourage here is your context and reason as to why you want to buy a property. So as an example, I want to buy a property because I can buy it today for $700,000 and it's worth $1 million in X amount of years. That growth is now my wealth. That's why I buy property, right? And that's really fundamentally why you should be buying property. So let's get into it. So now, actually, sorry, one more thing before we do jump into this, and I'm just saying this on the basis that I don't want to get in trouble for providing tax advice. There's no advice to this. This is not personal advice, guys. I'm not an accountant. Please do not go and take any of these things and go and do anything with it. Please take these things and speak to your accountant about it. I'm not an accountant. We've got great accountants here. I mean, I've had our accountant on our show. Please go and speak to the professionals who can give you this personal advice. Today, all I'm doing is just giving you guys some examples of stuff that I've done personally that's helped me mitigate tax before the time comes to actually start buying properties to start mitigating tax, right? So again, take everything I say today with a pinch of salt. It's purely ideas, purely general in nature. Please do not go and take anything that I say today and go and implement yourself without getting professional advice based on your situation. So let's get into it. So like I said, the context is don't buy an investment property purely for tax. There are other things you can do. So these are those basically different ideas. Now, first of all, and I know this is probably, the obvious option, right? And this is probably something that most people are aware of. However, you would be surprised at how many people I've met with that aren't actually aware of this. So I'm just going to speak to it first. The first thing that you should be doing as an employee when it comes to mitigating tax is looking at any work-related adjacent expenses. Now, I know half of you right now thinking, well, no shit, Corey, like Captain Obvious over here. Well, of course, but like I said, there's been a bunch of clients in the past who just haven't had no awareness of what they can claim in direct work expenses or adjacent work expenses. Now, let me give you guys some ideas. So, as an example, let's just say you are, let's say you're a carpenter, all right? Now, as a carpenter, like obviously you need tools, right? So you need saws, like circular saws, jigsaw, like there's a bunch of shit that you're probably going to need in order to fulfill on your job. Now, the reality is most companies out there, most employers aren't just going to provide you with brand new tools for you to go and use. So a lot of people, particularly if you're a contractor, they're expecting you to have your own tools so you can come onto the job, get the work done without any real problem. Again, I'm saying this on the basis that I have seen some people not actually aware that they can actually claim their tools as an expense. Now, that's a really good example of like a direct work-related expense, right? So you're let's just say, and this is a different example, right? But let's just say you're a barber, right? So you cut people's hair. It's probably expected to bring your own scissors, your own clippers, your own equipment, and that's obviously your station. But once again, many people that I've met with don't realize that you can go and claim those work expenses. So firstly, guys, ask your accountant about what the relevant work expenses are and claim as much as you possibly can to reduce tax. I have seen some people who have then done that and then saved thousands because they weren't claiming because they just had no awareness. So that's, again, slightly obvious, but that's one. Now, number two, adjacent expenses related to work. Now, what an adjacent expense is something that can be somewhat relative to your work and work environment. So let me give you an example. Since COVID, obviously, and even for us as a business, I mean, look, we've got almost 30 staff now, and we have 12 seats downstairs in office space, and we have 3 people in the office today. And that's pretty much how we have most of the office because most of our team work from home. Now, nowadays, when you work from home, you can start claiming work-related adjacent expenses, for example, a home office, right? Now, again, I'm not going to get in the weeds to tell you what you can or can't claim. That's not my role. I'm not licensed to do that or qualified to do that. But some of the things that you should be asking questions around are your office space at home. If you meet with people at your home, things like, for example, your part of your utility bill. So the power to generate, the internet cost, the power costs, the water costs, there are some work-related adjacent expenses. So not directly related to your work, but kind of related to you and your ability to work, right? So that could also be something to pass your accountant and ask them, do I have any work-related adjacent expenses that I can claim? Some examples could be your phone bill, right? I mean, I know for me personally, obviously my phone is practically a business phone. But for some of you who have to provide your own phone, if you're doing, say, for example, calls most of your day, or you've got to meet with clients on the phone, then I would probably suggest that your accountant may actually say, hey, we can start claiming some of your phone bill against tax as a work-related adjacent expense, right? So that's the second one. Now, number 3, contributing to your super. All right. So again, I've had multiple financial planners and advisors on this show before. One of the podcasts we had a couple of months ago was with one of our financial planners, Brahani. All right. This is an absolute weapon. And, one of the things that he really talks about is contributing extra money into your super to get not tax credits, but tax benefit. In fact, as you put money directly as a contribution from your, let's just say your pay into your super as a contribution, there are tax breaks and tax benefits you can actually get from doing that as well. All right. And again, I would speak to your financial planner about that and your accountant about that. But the reality is there are ways of you drawing your income into your super fund to help reduce tax and be a tax effective strategy. So that's number 3. Number 4 could be options around salary packaging. So again, I'm not going to speak to the what you can and can't do with this, but I'll give you some examples of stuff that I've seen in the past. People have a requirement for vehicles, right? So there are multiple suppliers right now who will allow you to salary package your vehicle in a pre-tax situation on your payslip through your employer. I've also seen some people, depending on your employer, be able to do the exact same thing in terms of salary packaging with your personal mortgage. There are a number of things that you can claim. All right, there are a number of things that you can actually pallet package into your salary. So essentially it goes via your employer through this salary packaging or salary sacrifice kind of arrangement where you can actually claim tax deductions and get some tax-free things that you would normally need for your life anyway. For example, cars, phones, like I said, that example with a personal mortgage. Now, that's not going to be relevant for every single person. But if you are considering on reducing tax, like what I would be looking at quite seriously is there a way you can salary package or salary sacrifice some of your personal costs? Because you got to pay it anyway, and it's better than paying it after tax. Let's try and pay it before tax, right? So that's also an option.
If you're overwhelmed by property investing, you're not alone. Most people waste months researching the wrong suburbs, stressing over inspections, and second-guessing every decision. Motivate Property cuts through all of that. We analyse the data, shortlist the strongest opportunities, inspect on your behalf, and negotiate so you don't overpay. The result is simple: a property that actually performs and moves you closer to financial freedom. Learn more at motivateproperty.com.au.
Now, when it comes to fringe benefit tax planning, so this could also be something, and again, probably not relevant for every single person out there, but similar to salary packaging. Are there any fringe benefits or things that are somewhat ancillary to what you're doing or how you live that can become tax deductible through future planning? Again, that's a question for your accountant. Ask him the question and then let him just start opening the door and see if any of that's relevant to you. So that could also work. Now, this is where things are probably going to take a little bit of a turn, all right? Because when I talk about these options moving forward, this is going to be a little bit more relevant to people who are self-employed or have the ability to become self-employed, right? So what I'm talking about now are entity structures. Now, for the majority of people out there, most of us would be working as a PAYG employee. So pay as you go tax. Your employer basically takes tax, sends it to the ATO, and then he pays you what's left over. You get a pay slip, and whether you're full-time, part-time, casual, that's PAYG. Now, some employers, and I'm one of those employers, some of my team have said to me, hey, Corey, instead of paying me as a PAYG employee, because it's an arrangement that kind of limits me quite a bit when it comes to tax and tax planning, can I set up a company and then contract you as a contractor that allows me to run a company, hold my employment through a separate entity, and then there's going to open up a bunch of different tax benefits and tax considerations and different strategies you can then deploy because you're a contractor working through an ABN, not a PAYG employee. Like I said, this is sort of where things can kind of go on steroids a little bit, all right? And the reason why I say that, now there's a bunch of options that open up to you, all right? Now, let me give you an example. Let's say you're working on the mines, right? Or you're working, I've got multiple clients who do this, whether they're, heavy diesel mechanic or whatever the case is. They have a conversation with their employer. They say, hey, Mr. Employer, instead of being on the books, can I actually contract through you guys via a company, pay me the exact same, so no loss to you. But what it does, it gives me the ability to actually be employed as a contractor and then start deploying these entity structures and different strategies in terms of tax. I've had multiple clients try it. Multiple clients have been able to do it, right? So whether you're a driller, whether you're, despite what your role is, I've seen this happen time and time again with the right questions to your employer. Now,
whether you're buying your first home or third or fourth investment property, Motivate Finance Team has you covered, finding the best lender to fit your needs. And here's the truth. If you haven't reviewed your lending in the last 12 months, you're probably overpaying. Banks reward new customers, not loyal ones. We review your structure, compare lenders, and build a finance strategy that actually supports your long-term goals. Whether you're refinancing, upgrading, or building your portfolio, your lending setup matters more than you think. Visit motivateproperty.com.au/finance to get started.
When you're employed as a company, there are a number of things that can start popping up. All right. So just as an example, you can start opening up family trusts. All right. So your employer pays into your company, income can get dispersed from your company into trusts. And then from there, again, there's a number of strategies that can be deployed, right? In terms of paying family, you can start things like prepaying tax. You can start doing things like contributing into your super. There's a number of things that start opening up from that point. The other thing to consider as well, there is also other questions to pose around the type of income that you have. Generally speaking, most people in that particular example will be earning PSI income or personal services income. In other words, the income you earn is practically based off your hands and the work that you do. However, In the future, if you have any ambition to grow that business or grow that company, and then you start hiring employees who start doing the work for you, then your income goes from PSI to non-PSI. And then all of a sudden, there's a number of new tax strategies that then pop up as well. So just as an example, one of the things that I do as a non-PSI income earner, I distribute income to my family. I distribute income to my wife, to my kids, to my parents, to my sister. There's a number of people that I can go and disperse income to. And once again, let's just say, for example, I earn $1 million a year. If I can go and disperse income to my parents who are self-retired, they're self-funded retirees. If I start dispersing income to my parents, a little bit to my kids, the point is, like, that $1 million worth of income is now spread across multiple people, and I'm not paying 45 cents on the dollar on every single dollar, right? Or every dollar above 190. So again, if you are employed as a company, or if you're a contractor to another company via a company, like I said, there's a number of different tax strategies that pop up. To be fair, if you could go to your accountant and start doing this sort of tax planning early, right, and start saying, hey, this is the things that I'm considering and what are my options, this is when your accountant will really be able to do some really good work for you, right? I'm going to talk to this more shortly. But one really important part of this conversation is actually how to use your accountant properly, which I'm going to come to. Now, like I said, what that then opens up are different strategies, and another strategy could be around family distributions, right? So income distributions. Now, as someone who does this myself, this is something that I would absolutely encourage people to deploy if they've got the ability to, because what it means, my wife is a stay-at-home mum. She doesn't earn any income. So whatever income that I pay her through, let's just say the Motivate companies, that becomes her income, and it helps me reduce my tax, right? But overall, we've still got the same household income. The difference is we get to split it across two people and then lower the thresholds. So that could also be a good option, right? And that's obviously family income distribution. Now, I think we're up to number 9 at this point. So one thing that people can do, and this is something that I highly, highly, highly encourage, is start a side hustle. Let's say, for example, you start a side hustle in car cleaning, right? Hypothetically. Well, guess what? You've now got a lot more work-related expenses, right? If you've got a business set up, company set up, it doesn't need to be a company, let's just say it's a business set up, and on the weekends you're now cleaning people's cars on your street, you can start claiming deductions on, buying some buckets, buying some sponges, buying a chamois. There's a bunch of things that, you can start claiming as now work-related expenses through that business, right? In other words, business expenses. Now, the reason why I think this particular strategy is so great, and I want to kind of, explain this. Firstly, having a side hustle for the most part for most people means you're essentially starting a little side business. I call it a side quest. I've got a lot of side quests. You're starting a little side quest, and the idea is you're going to be generating more income and basically making more money, right? Now, one of my what would you say? I wouldn't say he's a mentor because I've never met him, but one of the guys that I really look up to is a guy by the name of Grant Cardone. All right, for those who don't know who Grant Cardone is, he is a billionaire in the United States, and he made the majority of his money through real estate and property. In fact, when it comes to guys like Grant Cardone, as far as I'm concerned, goals, right? That's where we want to go. Now, one of the coolest things that Grant Cardone said, he does not have any non-tax deductible expenses. I'm going to say that again. He does not have any non-tax deductible expenses. What does that mean? Every expense that he has in his life is tax deductible. The question is how? What he does is he starts a lot of side businesses. All right. Now, let me give you guys an example. One thing that I'm extraordinarily passionate about, one of the things I'm extraordinarily passionate about is Brazilian Jiu-Jitsu, martial arts, right? So I train every day. We have a little gym downstairs just for us and the team and stuff like that, where we train and do jiu-jitsu classes. But the point is, my business partner and I, we've essentially opened up a business for the gym downstairs. Now, partly we obviously want to expand that in the future and actually open up a real, proper gym with weights and all that sort of stuff in the future. But for now, this is sort of meeting our aims. But at the end of the day,
if your investment property is being managed, but you're still dealing with stress, vacancies, or tenants who don't respect the home, you don't have a property manager. You have a problem. Motivate Realty runs property management the way it should be done. Clear communication, strict tenant screening, proactive maintenance, and complete transparency so your property stays protected and your rental income stays consistent. If you want a property manager who actually treats your investment like a business, visit motivateproperty.com.au/realty.
Now that we've got the entity, now that we've obviously generating income, now that that business is operating as its own business, I can claim kimonos, like so the gis we wear. I can claim all the different gear and apparel. I can claim mats. I can claim gym equipment against my tax. The point is, I've started a side hustle that is something that's one of my hobbies, which makes my hobby completely tax deductible. Now, what Grant Cardone is really saying here, every single hobby that you have, start a business. Then your expenses become tax deductible. So for example, another one of my passions is playing guitar. I love music. And not just play guitar, I play a lot of instruments, but I love playing music. One day, when I want to start buying some serious guitars and some expensive vintage guitars, obviously, you guys know where this conversation is going. I want to be able to buy those guitars tax deductibly. So I'm going to start a company. There's going to be an entity. That entity is probably going to be giving and providing guitar lessons for people to generate income. But then what it means is I'll have the ability to start buying guitars, the guitars that I want, through the company as a tax deduction. Right? Now, this is not tax avoidance. I'm not trying to avoid tax here. What I'm doing is I'm legitimately following the law and starting a business in something that I'm extraordinarily passionate about, in order to obviously generate income and make more money in the future. But in doing so, it also makes those expenses tax deductible. So once again, how long is a piece of string? There are a number of different side hustles you can go and start. What Grant Cardone is really saying here is make all your hobbies businesses, and then all of a sudden, all of your expenses become tax deductible. Now, Grant Cardone is obviously in the US, we're in Australia. So different tax laws, different regulations. But the reality is like we've got the ability to go and do that with our current tax laws over here. Now that I've explained, a number of options, and I think that was around sort of 9 or 10 options. Now is when I would start considering buying a negatively geared property and claiming the negative gearing deductions to start reducing my tax. But the reality is, I'm not buying an investment property purely for tax. That's a bonus. I'm buying it because I want the growth and I want to use that growth to buy more cash flow assets in the future. I would go and deploy most of those other strategies first before I even consider buying a property purely just for tax benefits. And that's fundamentally really what I was trying to say. Now, a couple of things to finish off here, and this is something that I think, hopefully this really helps you guys in terms of how to view this. So like I was saying before, when it comes to the tax system that we have, when you're, let's just say, for example, you're someone who's not very money aware, right? If you're not very money aware and you don't really understand the laws of money, how to use money properly, how money actually works, you're going to look at the tax system and you're going to think this is just this laws and regulations to restrict me in my life, and it's a pain in the ass system. And I understand that perspective. Someone like me, someone who's aware of money, the mechanics of money, how money fundamentally works, and I'm using money to constantly get put to work, I look at the tax code and that gives me strategies. It's a playbook. If you want to become wealthy, you need to consider the tax code, the rules and regulations as the way to win, not as something that restricts you. The wealthiest people are exploiting everything that I've said today plus some to benefit themselves and reduce themselves tax legally. The poor have no idea what I've just spoken about. They're not deploying any of these things. And then they kick the dirt and think, oh, well, my accountant just said just go buy property, so I'm just going to go and do that, thinking that's actually going to solve your problem. And it's just not. Right? So I guess sort of to summarize, the tax code in Australia is the way to play the game. Now, the second and final point that I want to make here, your accountant will be your best friend if you know how to use them properly. If you go to your accountant at the end of the financial year, when everything's done, and you say, oh, here's my receipts, anything else I can claim? They're probably going to sit there and think, oh, nah, probably not. And that's pretty much how your taxes are going to go. I sit with my accountant at the start of the financial year and I plan in the next 12 months. I plan and deploy most of those strategies I was telling you guys about today. But the point is, when I go to my accountant, it's not about getting answers. It's about knowing how to ask the right questions for him to start thinking and helping me plan. I never go to my accountant and ask him how to get wealthy. I never go to my accountant and ask him what I can claim. I go to my accountant with a bunch of different questions, a bunch of different scenarios, and I ask him what's going to be the most tax-effective way to reach this goal. The point is, don't be reactive, be proactive. If you can ask the right questions to your accountant and actually make him do his job properly, the way it's designed, that's how you're going to make far more money and pay far less tax. Now, the reality is, most people, like I said, they go to their accountant, they've got these receipts, they've got, some excuses and some stuff that they've forgotten, and then they just expect the accountant to just, be a wizard and make all this stuff happen, right? The reality is, most accountants out there don't want to do your boring ass tax return. Most accountants out there want to be able to do really in-depth strategic planning and implement all these different scenarios for you because they're going to make more money doing that and providing you better advice. But the point is if you want to ask the right questions and being proactive and trying to ambitiously make multiple different things work, the reality is you're just not using your accountant properly, right? And this is fundamentally what I'm trying to come from. It really is about thinking forward, facing forward, and trying to maximize your strategy, your situation, and really anything to do with tax. And as you guys know from listening to this show, right? I am so against our tax system, it's not even funny. And yet notice how my attitude right now is saying that it's actually benefiting because there's all these different things that I'm doing to reduce tax, and I'm doing it legally. Nothing we're doing here is illegal. It's completely above board, and the wealthiest people in the country, particularly politicians in Canberra, they're all deploying this shit for themselves. So why don't you? The problem is most people aren't really aware of it, right? And that fundamentally is really the main thing I want you guys to be clear on. It always comes down to the questions you're posing to your accountant, because it's your leading questions that's going to allow him to get his butt into gear and start doing the right things for you to make sure we're being proactive and deploying as many of these tax strategies as you possibly can for your situation. So like I said, guys, that's pretty much it for today. I just wanted to really kind of explain that. And once again, James, really appreciate the question, man. You're a legend for sending it through, dude. And any of these questions and comments and stuff we get, I always want to make sure I answer them, because that way you can get the right answers the way you want it, even though the answer may not be the answer you wanted. But the point is I want to make sure that any of the feedback or any of the queries and questions we get, we spend time in actually responding to you. So really appreciate it, James. That's pretty much it for this week, guys. Thanks for listening. Have a great week.